Welcome to the MUFG Global Markets Podcast. I'm your host, Ellen Tang, and today I'm joined by Glenn Schultz, the head of agency mortgage prepayment modeling and strategy for MUFG. Today is Friday, May 12th, and Glenn, always good to talk to you. Thanks for coming back.
Hi, Ellen. My pleasure. Thank you for inviting me.
Of course. So like we always like to start off the monthly podcast talking about the prior month's remit data, which was released on May 4th. The aggregate prepayment, as measured by the Fannie Mae 30-year prepayment, reported in around 5.1 CPR, which is about an 8% decline month over month, outperforming the business day count convention of about down 9% month over month. The 15-year sector reported about a 5.9 CPR, declining about 13% on a month-over-month basis. And then the GNMA sector 30-year mortgage prepayment reported a 6.4 CPR, which is down about 7.5% on a month-over-month basis, while the 15-year sector declined about a little over 9% to 9.3 CPR. So after, kind of reiterating those numbers, how does the April remit data stack up against your turnover thesis, given your turnover forecast is higher than that of the overall market?
Right. Yeah, my turnover forecast is higher than the overall market. Just to give you a sense of where that sits, twos, which are the deep out of the money coupon. If we look at our prepayment model, we're reporting like a 9-10 long-term CPR, so that's over the life of the security. And I think if you look at sort of the other model vendors, you're getting something in the neighborhood of like 5 or 6. So yeah, we're much faster. And right now, when I look at the S curve deep out of the money, say 250 basis points, everything is consistent with pretty much the historical turnover rate, which is higher than what these models are predicting. So, for example, production deep out of the money cohorts, their actual prepayment is around 4% CPR just in this current remittance period. And so that's on track to fully season, right, to around an 8 CPR, while similar moderate and seasoned production cohorts are paying between 6 and 8 CPR respectively. So I still feel that our view on turnover is going to be proven to be correct, in that during the peak of the coming home selling season months, which are May through July, those will report turnover rates between 8 and 10 CPR in the at the money cohorts, right? So if these out of the money turnover rates are dragged up, then these could be achieved as well. And then the market would likely revise discount prepayment expectations upward. And that would lift valuations in the lower coupons. So I think the May through June months are going to be kind of big months for the turnover question, and they're going to be big months for the deep out of the money cohorts.
Got it. And then in this month's prepayment insight, you had mentioned that loan balance sectors have really proven themselves to be the kings of carry. Could you elaborate on this a little bit in the specified pool sector?
Sure. When I look at the S-curve profile in the loan balance sector, what really jumps out is what I call the convexity cross, right? And this occurs right around the 4.5 and 5 coupons. So pretty much you're on either side of par, right? When you're at that 4.5, 5. And the lower discount coupons are exhibiting prepayment ratios, right? That is a loan balance to TBA ratio in terms of 1 month speeds greater than 1.0, which means these loan balance coupons, especially in a discount market, obviously are offering superior carry relative to comparable TBA. And this is most pronounced in the low, moderate, and moderate high loan balance sectors. Similarly, in the high coupon premiums, these are exhibiting prepayment ratios that are less than 1, so to the right of the 4.5 and the 5. And so they do offer superior carry relative to TBA, but based on how the market is pricing things, it's really to the left in the discounts where I think the value is. And so that convexity cross and where we see those ratios playing out against the backdrop of prices right now, that's what has led me to favor the 3 and the 3.5 coupons, sort of in the loan balance sectors.
Got it. So shifting the conversation a little bit, let's kind of go over to the mortgage basis.
Mhm.
Since February, the basis has trended wider. Can you share your thoughts on this? Mortgage
Yeah,
basis?
yeah. So when I think about the mortgage basis, I tend to look at, monthly and weekly technical charts. I put those in a number of client notes in the past. And I use that to really form my opinion on the basis from a technical side. And right now, both the weekly and monthly charts, they're all at the upper end of their respective Bollinger Band ranges, if you will, and neither are really suggesting that the basis is oversold. So this leads me to think that we're really kind of in a period of consolidation at the upper end. But the agency MBS market really needs to clear a few hurdles before we can see kind of the upward pressure taken off the basis. So first, we have to get through the FDIC liquidations of the failed banks, SVB, whatnot. And then the second is the debt ceiling and the budget negotiations. So with that said, I feel there's some risk to wider agency MBS, but I think that's going to be limited to around 180, which, we've discussed this in the past. My feeling is when we hit 180, we're really at stress levels, and I mean that from a financial conditions, more macro basis, which I don't think we're at that point really, those stress valuations. But still, the FDIC auctions, although they had been well received and pricing relatively strong, today's indication that the FDIC limited auctions would be like 12.5 billion, really caused the basis to come out. So I feel like once the market kind of clears these macro events, right, the liquidations and whatnot, and barring any kind of further bank failures or some other black swan event, then my sense and feeling is that the basis will likely tighten through Q3 and Q4 of this year. So I'm still really holding to my year-end target for the agency mortgage basis of around 120 basis points.
Great. And I'm glad you mentioned the current debt ceiling negotiations. What implications do you foresee for agency mortgages given the government's guarantee of GNMA MBS, implied guarantee of conventional MBS amid talk of a default on the part of the US government?
Well, first, I doubt that, the federal government will, default on its obligations. I don't think anybody sort of takes that seriously. However, I do feel like it's sort of pretty irresponsible, irrespective of, what party or party affiliation particular politicians are aligned with, to even kind of raise the specter of U.S. government default as part of a negotiation tactic. And I say this because the last round of Brinksmanship, where the kind of the default was put on the table, right, resulted in a downgrade of government debt. So, it's kind of split rated right now between AAA and AA plus with S&P. And so, I think this could be enough to kind of push the rest of the rating agencies to split that debt rating as well. And so I think it's important to kind of keep in mind, that overall credit worthiness is really kind of a function of the borrower's ability and willingness to repay. So that applies at an individual level, it applies at a corporate level, and I think it applies at a sovereign level. And so budget brinksmanship really calls into question this ability and willingness to repay. So I think the more likely outcome of all of this, in terms of the budget standoff and default, no default, and that thing is really raising the risks of yet another U.S. government sort of downgrade of the debt, right? And in my view, a downgrade would be very negative for Ginnie Mae sort of MBS, maybe neutral for conventionals in the sense that both Fannie and Freddie use now credit risk transfer technology, which makes the conventional MBS more or less sort of self-insuring, like a private label senior substructure, And that CRT, or that credit risk subordination, stands before the implied government guarantee, whereas GNMA is a government-owned corporation and relies kind of solely on its government guarantee, as well as its favorable risk-based ratings, but still, I think it's something that would probably maybe hurt GNMA a little bit more than it could potentially hurt conventional. So that's really kind of what my focus is, and I'm thinking about it and trying to work out how much, but it's not going to be a positive.
That's an interesting take on the implications of the current debt ceiling, Glenn. And, that kind of puts us in a place where we're wrapping up the podcast for this month. And as always, thanks for joining us again.
All right. My pleasure. Thank you.
And to all of our listeners, you could go ahead and rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And please reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.